All right, cool. Let's get this party started. Welcome to 20 Fathoms. Yay. I'm Maria Purvis. I'm the engagement manager here. For those of you not familiar, 20 Fathoms is a nonprofit tech startup incubator and co-working space, which we're sitting in right now. Event programming in an effort to grow our tech community here in Traverse City, and this is a part of it. So we're happy to welcome Matt Bauer from Varnum, and then Bradley Matson and Steve Lang from Northern Michigan Angels. And with that, I'm going to let Bradley take it away.
All right, so today we're going to talk about term sheets. And so again, I'm Bradley Matson. I'm the admin director at Northern Michigan Angels. And we have Steve Lang, who is on our board and also the chair of the membership committee for us. And so we're going to start off just a little bit about Northern Michigan Angels in general, a little bit about angel or early investing, and then kind of a little bit about the angel community that we have in the state here. And then we'll kind of kick it over to Matt for more of the guts of the term sheet discussion here. But we'll try and keep it a little bit open and answer any questions or talk about some experiences we've had and that kind of thing as well. So let me know if you have any questions as we're rolling. So again, a little bit Northern Michigan Angels. So we are an angel investment club, if you will. So everyone is an SEC accredited investor. We have a dual mission, both to help grow the regional economy and then also to find some ROI for our members. A little bit about the kind of the stage that we invest at, because not everyone's necessarily familiar. The larger kind of VC firms get all the good movies and stuff like that, and then we're all familiar with friends and founders and fools and that kind of thing. But there really is this kind of middle step, if you will, that is an important last step on the ladder for a lot of local startup companies. It's that in-between section there, and it actually makes up a larger chunk of all kind of early investing, more than you think. Obviously, the biggest chunk is friends, family kind of money, just because every startup needs that level. Not every company, of course, is going to grow, but those that do need. And it's that kind of middle of the road that gets them up to a position where they might be fundable by a bank or VC or some of these larger governmental funding entities. But we do bring more than money. We bring a network of guidance. And we'll talk a little bit more about kind of who's in our membership. But a little more about the types of companies. Like I said, we don't invest in any early business or any small business necessarily. We specifically are looking at businesses that are likely to grow or scale.
Service or
Is that a question here? Yeah.
That was a whoopsie.
Okay. We're looking specifically for companies that are likely to grow, so we can actually get that ROI kickback that'll make up for all the ones that don't grow. And then we're also specifically looking at companies that are likely to create a lot of jobs regionally. So a little bit about our members. Do you want to take this one?
Yeah, I'd be happy to. We try to maintain over 50 members in the organization at any point in time. I think we're today, as we sit here, at about 54 members, which is great. We have a broad range, breadth of experiences from the members, people from all walks of life, all kinds of business experiences. And the reason that's important is I want to emphasize that we are not a passive fund of members who just put money in and sit back. It's a very active organization. Our members work in teams to pre-screen companies, to take them all the way up through the investment, and then to help manage that as often deal leads to obviously what we hope is a successful conclusion. And our members work as mentors to the owners. We have had members on boards of the companies. So it's very different than just an organization that's giving money away to budding young companies. We actually maintain a real high activity level. So that's the key takeaway from that slide. Been at this for a little over 10 years, and have, as you see here, made a lot of pitches, or seen a lot of pitches. A lot of companies have been funded. We currently, I think today, have about 38 portfolio companies active, and $7.5 million cumulatively have been invested in Michigan Angels. So a lot, and set 38 companies today that we are actively managing. Okay. A great example for us is Atlas Space Operations. It's a company that we first invested in 2017. I think made up maybe 5 of total investment rounds in Atlas Space Operations. They relocated to Traverse City. We were discussing earlier this morning the total number of employees they have. We think it's in the 20 to 40 range here in Traverse City, which is great. These are higher end positions. Atlas is a global management system for ground to satellite communications, and they have been very successful and have experienced in excess of a 5x increase in evaluation. So it's a great example of all the things coming together to meet the needs of having a great company that for a good, hopefully in the future, return on investment, but also one that serves the community quite well. So those are the things we look for in our company. Okay. We're a fairly large angel group inside a pretty robust community throughout the state of Michigan, as you can see here. At 54, we're actually in the within the top 5 in the state of Michigan. We're the only angel group north of the Bay City, Saginaw, Midland areas. So we are in a good position as far as being able to support northern Michigan, and we do it pretty much exclusively. But we do work with the other angel groups, and often we find ourselves investing in the same companies they invest in. We work to syndicate the investments so that we can get the right amount of money to these organizations to help them grow. And then last comment is that we aren't doing this all by ourselves. We're sitting here today at the 20 Fathoms office, and we work very closely with a lot of different organizations, including TC New Tech, Boomerang Catapult, 20 Fathoms, are going to be participating in the Northern Michigan Startup Week, work with Traverse Connect. A lot of our members, are in mentoring situations through SCORE, for example. And these are some of the companies that are local that we have supported, and a couple of them, all of them are involved actively as we speak today in the Traverse City market. So we're really excited about being part of what we call the ecosystem that hopefully will continue to put Traverse City forward as a premier site for supporting startups. And I think that's it.
Yeah, and just before we hand it over to Matt here, just if you have any other questions, or you want to learn more about NMA, you can go to nma.fund or northernmichiganangels.com, and yeah, we'd love to connect.
That's great. Terrific presentation, guys. So my name is Matt Bauer, as previously announced. I'm an attorney with the Varnum law firm. If you're not familiar with Varnum, it's a full service law firm. Our main office is in Grand Rapids. I lead our Ann Arbor office, but we have, I think, 7 offices throughout the state. and while we're a full service firm, my practice focuses on representing startup and early stage technology companies. I do a little work for investors, but primarily I'm representing the companies and the founders. And I work with these companies usually at a very early stage through, we call it from cradle to liquidity. So from the very first formation until that final exit event. I'm working quite a few exits these days. So, one thing I'll say about angel groups in this state are they become increasingly more and more important. So, our startup ecosystem is not Silicon Valley or New York or Boston or really even, Boston or Boulder. We're a little bit more spread out, obviously, as a statewide, ecosystem of technology companies and startups. Because of that, we tend to have sort of like regional centers where there's a lot of startup activity. I think Northern Michigan, particularly Traverse City, we've obviously seen a huge increase in tech startups in this region. I think COVID only accelerated a trend, which was companies looking to locate to areas where they want to live, right? And not where they feel like they have to be for resources or capital. So increasingly, the angel groups throughout the state have really been filling this really important gap that was on the slide there, which is getting past the friends and family stage, getting some growth capital in there to really get to the next stage of growth. So it's really terrific work that you guys are doing. I work with a number of other angel groups throughout the state, Birmingham Angels being one. And so it's also for those who are interested in angel investing, it's a really important part about an investment strategy. You can invest money in the stock market and make a percentage on your money. You can invest in real estate, you can invest in commodities. I have a group of investors that invest in bourbon of all things. I think it's more just fun so they could go visit their barrels, but you can get a percentage on your money on these things. Well, investing in startups is the only way that you can get a multiple on your money, right? And it's high risk, but it's very high reward. And it should really be a part of anyone's investment strategy. I'm a LP in a early stage fund myself. Because of the work that I do with startups, I try not to invest directly in clients, but yeah, so really recommend if you're interested to try to learn more about it. And with that, I will share my screen. So, what I thought I would cover today is sort of a basic term sheets for what would be a Series Seed preferred stock financing, convertible debt financing, and a safe financing. And I'll describe a little bit about when might be appropriate for what transaction and some of the major differences between these types of securities. And that's what we call these, any kind of investment that's being made into a company, either the stock or the safe or the convertible note that you're getting back, that's a security and it's regulated both the state and federal level. So with Series C preferred stock, so a Series C preferred stock round is typical if the company is raising a significant amount of cash. Usually like $1 million plus, then we would recommend doing it as a preferred stock round. It sometimes depends on the investor and the company and where it is in its fundraising life cycle. But typically a seed stage would be you've received some friends and family money, you've maybe gotten some angel investment capital, and now you probably have a venture capital fund that's interested in making the first equity, leading the terms for the first equity round of financing. So it's a important milestone in the company's fundraising life cycle. It's a little hard to see perhaps, but this is what a Series Seed term sheet would look like. It's relatively short. It's going to be a couple pages. This comes from one of the great innovations of venture capital financing over the last, 15 years or so, has been the open sourcing of transaction documents. It's made deals more standard. It really helps make the deals more efficient. a term that we often use in venture capital financing or really just investor financing is, what is a market term quote? And the more that you stay sort of within the market, the more efficient to be structured. The more you sort of veer off market terms, the more expensive it can be, the longer it can take to get the transaction closed. The more complications it may have for future financing rounds depend on these off-market terms. So a lot of the work we try to do is to kind of hammer the deal back into our standard documents. So this term sheet comes from seriesseed.com. You can look it up. Those transaction documents are all available and open sourced online. Likewise, if you want to go, to the next stage up, you can go to the National Venture Capital Association has the model documents available. They're heavily footnoted. If you ever have trouble sleeping, you can crack those open and start reading them. But they provide a lot of detail on what are standard terms, what are the variations within each of these terms. So I'll go into a little bit more detail on this. So you have sort of this introductory paragraph. And what this does is it basically states that this is a summary of terms, but it's not legally binding. Having said that, I don't know that I've ever had a client sign a term sheet with an investor that didn't close. So it's a little unusual for the parties not to proceed with the transaction once the term sheet has been circulated and signed. So the terms, the type of security to be issued. So you've got Series Seed, you've got Series AA, sometimes it's referred to. Frankly, you can call it anything you want. We'll just put it in our legal documents. There tends to be from investors and the company, though, what you call your round is a signal to the market. So it's important for marketing purposes, like if you're really at a seed stage, to call it a seed investment. If you're at Series A, there's a certain expectation among the investors who are investing in that round as to the stage that you're at. Aggregate proceeds, so how much are you going to raise? Like I said, for a seed round, typically it's going to be north of $1 million. It's unusual to do it south of $1 million just because of the cost involved. And then the investors. It was mentioned accredited investors only. Credit investors, sometimes referred to as fat cats. They actually aren't that fat under the SEC rules, although they're annual income of $250 a year, $350 with their spouse, or $1 million in net worth, not including the principal residence of their home, since everybody lost money on their house in 2008. So the price per share. So this is obviously one of the key negotiating points, and usually it's based on what's called a pre-money valuation. Although increasingly now we're seeing term sheets that are calculating the price per share on a post-money valuation. Do you guys have a preferred method of calculating? Do you pre-money or post?
For the most part, it's pre.
Yes, and the question on that is, if you get a post-money term sheet, if there's notes converting,
Yep.
do you assume that those are, or you just subtract the raise and those are the net number?
It's actually worse than that. So I'm not a fan of post-money cap or term sheets because I think it hides the ball for the entrepreneur about what the actual true implied pre-money valuation is. So the post-money is, let's say it's 10 million. Let's say the investors are going to invest 2 million. So you might say like, okay, well, that's an $8 million pre-money valuation. Except that if you have $1 million in notes, then what you might say is, oh, okay, well, then it's a $7 million pre-money valuation. Except if the notes, right, converted, say, like a $5 million valuation cap, so much lower than our valuation, you really have to include in the value of the notes on a post-money basis. So it's going to drive the pre-money valuation down even further. So once you do the math, which is a little mind-boggling sometimes, then you come up with this implied price per share. And so it happens time and time and again that clients get a post-money term sheet, and then after we do the math, they say, oh, right, because once you take into consideration all the convertible securities, because it could be notes, it could be safes, and what the value of them are on a post-money basis, your pre-money valuation is a lot lower than you think. And yeah, this sort of explains a little bit of that. One other thing too, I think it's on the next slide. So it's also on a fully diluted basis, and so this is another way in which the pre-money can be, or the price per share can be driven down a little bit. Is that oftentimes the option pool is going to be included in the pre-money capitalization, and it's going to be a fresh pool of maybe say of 10% over and above what's ever been issued to that date on a post-money basis. So when the transaction's closed, you have 10% available in an option pool, but you'll have to increase your pool pre-money, right? And it's included in the capitalization. So that drives down the per share price even further. So that's also something for certainly founders to be made aware of. Sometimes you'll see, term sheets that say, we want a 20% post-money pool. Well, that's probably larger pool than the company needs. It's probably just artificially lowering the price per share. And so the way that, founders typically combat that to say, hey, look, this is our hiring plan over the next 12 to 18 months. So we think we only need 10 or 15. A 20% pool might be appropriate though, if they have to go out and hire some C-level folks, right? So they're going to need a lot more dry powder for that. And so that can make sense. So it really depends on what the company's hiring cycle is going to be. So liquidation preference. There's primarily two today. There's what's called participating preferred stock and non-participating preferred stock. Participating preferred stock is the investors get their money back, and this is on a liquidation, right? So cash is coming in. On a participating preferred stock, the investors get their cash back, and then they participate on a pro rata basis with a common stock on an as converted basis. Non-participating is the preferred stockholders get an election. You can either get your money back or you can participate on a pro rata basis. I would say it's sort of more standard these days to have non-participating. Back when I started with venture capital financing, sometimes you would see multiples on the preferred preference. I think with the amount of competition now there is for funding, that's sort of less common, but not completely unheard of.
Matt, are you taking questions real quick?
Yeah, we can take questions.
On that point then, and I can't see.
Yeah, I'm sorry.
The non-participating, the wording there would be that they convert plus their dividends.
Yep.
Period. And are we just assume then that they also have the option to convert?
Right.
So that they can participate?
That's right.
With the common.
Yep. Yeah. So either they would say, we'll just take your preference, or we'll convert into common. The way it's actually term sheet or the documents are drafted is just, you don't have to convert in. We'll just pay you off as if you had converted, essentially. So voting rights. So typically common and preferred vote together on most things, but preferred do get a veto over certain major actions. So these are things that would really materially alter the investor's investment in the company, right? So it would be things like, changing the rights of the preferred stock, authorizing additional shares of preferred stock, usually of a class that's superior to the current class. Redeem any shares, pay any dividends, and certainly liquidate the company, right? So preferred stockholders voting together as a group get to have a separate vote on major actions like that. Another important term in preferred financing is the makeup of the board of directors, right? And so this really goes to management and control. This tends to be the thing that founders focus on the most, right? Is control, where I really think most of their emphasis should be on the economic terms. But this is often negotiated over what the makeup of the board of directors is going to be. Typically on a seed round, you would have at least one preferred director on the board, and maybe the common stockholders, the founders, would get 2 seats. That's not an uncommon board to have. A more balanced board is there's one common, the CEO is going to take a seat. Typically, starting off, of course, the CEO is also going to be a founder. Then you're going to have 2 investor seats. Then you might have an outside director seat. That's a more balanced board, and this board makeup is more typical for, say, a Series A. Other terms, information rights, so financial statements on a quarterly basis, right to talk to management and maybe tour the facilities. Participation rights, usually these are reserved for major investors, so over a certain dollar threshold, but they would get the right to participate on future financing rounds, their pro rata amount, right? So if I held 10% of the company and there was going to be a round of $1 million, I'd have the right to invest up to $100,000 in that round. Expenses. So typically the company is also going to cover the expenses of the lead investor, usually their legal costs. For a seed round, 10 grand might be a little low, but and it's negotiable. But it depends on how many parties are involved, the sophistication of the parties, but what that number is going to be. And then future rights, typically they're going to be able to reserve for themselves the ability to retain whatever rights they have into the next round of financing. There's certain terms for founders. So one is, restricting the founder's stock. This is actually something that I do for startups that I work with, regardless of whether they've received any investor financing. And what it is we call it, so-called reverse vesting. So, when an investor puts in cash into a company, they're getting stock in exchange for their cash. The founders are not putting in cash typically. What they're providing are services. So that's their consideration for the equity that they're receiving. So if for whatever reason, a founder doesn't provide the services over a certain period of time that are expected, that they don't get to keep all of the stock, right? And you see this sometimes, founders leave, maybe they get sick and they can't work anymore. If they stop providing services for whatever reason, they're going to forfeit some of their stock. And so a typical term sheet will say, if you haven't restricted your stock up to this point and it made it subject to reverse vesting, you're going to do it now when our money comes in. Like I said, it's reverse vesting. Double trigger, there might be, acceleration of some of the vesting on a liquidation preference. Or double trigger is, we have a liquidation preference, you're going to get 12 months of vesting added, right? And if you're not retained by the acquirer, you get another 12 months. So it's a little bit like 24 months of 12 months for good for you for selling the company, and another 12 months is sort of your severance in a way. IP assignments. So this is also an important thing that we do when we work with early stage companies. We want to make sure that their corporate house is in order, but also that they have good title to their intellectual property. So we make sure that all the founders have entered into proprietary information. You mentioned assignment agreements. Other things that you might find in a term sheet are dividends. Usually dividends are if and when declared by the board, and for early stage companies, they're never going to declare a dividend because you always want as much cash as you can going towards growing shareholder value and not coming out of the company. Occasionally you'll have investors say, I want an 8% cumulative dividend that you can pay me on liquidation. In a sense, it's giving them like a 8% guaranteed 8%, well, not guaranteed, nothing is, but 8% return over and above their liquidation preference. It's modest juice. No one's getting rich off of 8% on their money, but you'll sometimes see that as part of a deal. And then redemption rights can be a little tricky. So some investors will put money in on a preferred stock financing round, but they'll say, I get the ability to get my money back, after a 5-year period. So the investor can force the company to redeem their interest. That obviously can put the company in kind of a financially tough position. There's also, under the law, a company can't, put itself into bankruptcy by paying out a shareholder. So there's just some natural things that might prevent a a company from even being able to honor a redemption right. It's really just for an investor. If you made an investment in a company that's sort of gone, zombie, right? It's not dead, but it ain't alive either, and it's not growing. So, in that kind of situation, the redemption right can kind of just give the investor some leverage to say, I want out, let's work something out. And so the redemption right can provide that kind of leverage.
Yeah.
Yeah.
We used to try and push for that in some of our early deals.
Yep.
And we kept hearing that it also discouraged the VCs to come in. They didn't like those.
Yeah.
redemption rights.
If the VC doesn't like it, they can just say, we're not writing a check unless you get rid of it, right? And then you can sort of make that decision at that time. It's fun. I have a client that just received a term sheet. It's a very large financing round. It's 8 million Series A round of financing, and there's a redemption right in there. And one of his early board members is on the board, and so we're kind of going back and forth on the term sheet, in this board meeting. And of course, I'm I'm representing the company. I'm like, no redemption rights, period, out. And the VC who's on the board's like, they're not that bad. So I think it sort of depends on the perspective. I mean, ideally for the company, you don't want them, but at the same time, it is their articles, right? They're not a suicide pact. If the redemption right is not going to work in order to raise additional capital, you get rid of it. Convertible debt. So let me talk a little bit about convertible debt and safes, because I'm going to go over both of them here. Convertible debt and safes make a lot of sense for companies that are raising in sort of that angel phase, right? You can certainly, it actually makes a lot of sense for friends and family as well. I don't know, you guys, how often are you doing stock versus convertible debt or safes? Or
Yeah,
Mostly convertible.
yeah, how do you feel about safes? Not a fan.
Yeah, we're working on some ironing out some.
So let me just paint the picture for you. So, so it used to be back in the old days of doing venture capital financing, everything was some kind of preferred stock financing round. But what happened is that those rounds would take a long time to close and they would be expensive. And so what you needed to do was bridge the company some money, right? So that it could keep going until you closed on this preferred stock financing round. And so those bridges became loans that would convert into the preferred stock in the financing round. Increasingly, that instrument, that bridge note, began to be used just for seed financing, period. So we're not sure when the financing round is going to take place. It's not imminent, but this is a quick, easy way to get cash into the company. And so let's just use these bridge notes, which then became known as just convertible notes, because they weren't a bridge to anything. They were just convertible notes in the financing round. And then they would convert. So I can go over these terms, but they would convert in the financing round, and then and that seemed to work pretty well. The problem with convertible notes is that they do have a maturity date. So you would have companies, again, sort of in the zombie phase. They're not dead, but they're not really thriving. And then the notes would come due. And the quick question was, well, what do we do now? Right. So the investors could call the notes, put the company, into liquidation and call it a day, or they could negotiate at that time to convert those notes at maturity into some kind of preferred stock. But it increases the transaction costs for the parties, right? Because obviously you got to figure out what you're going to do at that point, and then you got to get the lawyers to document. Increasingly, you had these accelerator programs who were bringing companies in, and they were doing these convertible notes. Now, what they're doing is they're just buying lottery tickets, right? And if you want your lottery ticket to hit, you have to buy as many lottery tickets as you can. So you've got to increase your numerator. So they're issuing all these notes, but then all these companies were going bankrupt, or closing their doors, or not having a conversion event like a financing round. And so they got stuck with all these notes that are out there, and they didn't want to have to deal with them, right? So they invented something called the SAFE, or Simple Agreement for Future Equity, which basically says it's like a note, but there's no interest rate typically, there's no maturity date. And so it's just either going to get paid out and convert, or it's going to get converted in a financing round, or you're going to pay it out if the company liquidates or if the company gets sold, right? And so it was a cheaper lottery ticket for them, where they didn't have any transaction costs after they gave it to them, unless there's going to be a conversion of it. And so that's where safes have come from. So it makes a lot of sense for angel groups who are not just buying lottery tickets. You guys are invested in your companies, not just with cash, but with your own services. That, you know, convertible notes make a lot of sense for angel groups because they want there to be a maturity date. They have a relationship with this company that they're investing in. They want to keep their eye on the maturity date, and they want to use it as some pressure and leverage to get them to get to their next financing round, right? Or have a very clear idea that like this company's just not going to make it. And so they have a clear idea of what's going to happen on the maturity date. So I think I just explained my last few slides, but I'll just zip through here. And so why convertible debt? Yeah, it's cheaper, it's faster. The founders do typically retain control, although there can be what are called side letters as part of convertible debts or safes that might give the investors some additional rights, including information or board observer or even a board seat, so long as the notes are outstanding. There's the amount that's going to be raised, an interest rate, the maturity date, typically 12 to 24 months. The conversion events, as I mentioned, you know, you're going to do a next equity financing round. Usually there's a minimum amount of money that the company has to raise in order to trigger an automatic conversion on an event like that. You got a corporate transaction, which is the sale of the company. Typically, you're not going to want the company to sell unless there's going to be some significant return for the investor. So typically, the investor is going to require 2x their money back if you're going to sell the company before the note converts, or they can participate on a pro rata basis. And as I mentioned, the maturity date it could be another conversion event, right? The terms, so, you know, in the equity financing round, we have what is it going to convert into? Typically, it's going to be either a discount or it's going to convert in at a cap. Cap is essentially what the value of the company is from the investor's perspective at the time the note's being issued. You know, caps used to be there to kind of protect the investors in case, you know, you invested, you know, at a very early stage and all of a sudden they skyrocketed and then they were doing a Series A round at a $15 million valuation. Well, for the investor, just getting a 20% discount on that round is not a great deal for them, especially since they were such early money in. And by the way, the company did it with the investors' money and now converting them in at just a discount on this very high, you know, valuation round. I mean, good for the company, but to protect the investor, you set a cap. So, so that cap is, I think, very important as part of the financing round to make sure the parties are aligned. And as I mentioned, you know, corporate transaction or maturity date. Terms, typically, companies not going to be allowed to prepay. Occasionally, you'll see convertible notes with security, security being, security against maybe all the assets in the company. I think it's less common these days. Priority, typically you want them to be subordinated. If the company can go out and get bank financing as an investor, I want them to be able to get access to that additional capital. Maybe it gets capped at something. I think the banks typically are going to cap it themselves, especially if it's really early stage.
Can I ask you, can
yeah.
you back up 1 second about that cap?
Sure.
Why it's so important and how it protects the investors?
Yeah. So for the company, if I take an investor's capital and it's a convertible note, right? We're deferring converting that investment amount until the next equity financing round. So what the company is valued today, taking that convertible note, is going to be much lower than it's going to be for that convertible round, presumably, right?
Right.
So the company is going to take the investor's money, use the investor's money to drive up the valuation on the investor, and then convert the investor into the round at that new higher valuation, having used their money to do it. So,
Which dilutes them?
well, it doesn't do well. They just don't get they don't get a commensurate amount of equity for the risk that they took early on.
Okay.
Right? So if all you're offering them is a 20% discount on the next round, if the valuation hasn't gone up that much, it's probably not a bad deal for the investor. But for these companies, they're meant to scale very quickly, and they can sometimes. So you can have a company that, you know, is just two guys here that push some desks together and call themselves a company, and the next thing you know, they've got ARR of, you know, 3 million, you know, on a SaaS product. And so, you know, their valuation on their Series A financing round could be 15 million. So for me, having invested when they were just two guys with two desks together, and just to get a 20% discount on that round, that's a bad deal for me as an investor.
Understood.
Yeah.
Okay, thank you.
Matt, of the last 20 that you've seen that converted, how often did the cap come into play?
100%.
It did.
So does the cap prevent that round of funding, or does that just change? how
Not
they
at
get
all.
paid
So
out?
occasionally what you'll see is that if you do have a super high growth company, and if you have investors who came in at say a $3 million cap and put in $1 million, they would get 25% of the company, right? Those note holders on a post money basis based on a $3 million pre.
Okay.
So new investors coming in may say that deal is good and maybe a little too good. So I'll give you preferred stock for your cash, but I'm only giving you, there's lots of different ways you could do it, but I've seen this a few times. You're going to get common stock for anything over and above what would be your cash value at the $15 million valuation, right? So they don't get all of this upside protection. Or what you might do is we create what's called a shadow series of preferred stock. So they don't get the full amount of the liquidation preference at the 15 million. They just get, you know, in a sense, their money back, right? So if the price per share is $1 in the preferred stock financing round, but we can really convert it in at say 15 cents, then we're getting all of this liquidation preference, right? Over and above our investment amount. So you create a shadow series of preferred stock and say, no, your liquidation preference is $15, 15 cents a share, even if you'll still get the same number of shares as you would on, you know, converting in at the $3 million valuation. That makes sense.
Mostly.
Okay.
Sorry. Good enough.
Yeah, and again, expenses, typically the company is going to cover expenses, but convertible debt typically much cheaper. Saves,
I'm sorry,
Yeah.
but the one point of that is, my understanding, the next money coming in.
Yeah.
They're still gonna dictate the terms. They're still gonna, you can have that cap, but they're
Right.
still gonna say, that's all well and good. But if you want this event to happen, we're gonna change. some
and the
things."
existing investors get a say in that typically. Now, if your convertible debts are safes, you know, maybe you just have to go along with it. Although your safe says what your safe says, right? So you don't amend your safe. Like if an investor comes in and says, this is the way it's going to be, you know, you've got some say in that as an investor. Now it's, you know, it's a business decision and it's a conversation, right? And, you know, ultimately at the end of the day, you know, you want to get a return on your investment. So, and again, sort of like within what are sort of market terms, like what's considered acceptable, what is considered, you know, off market. So it's a negotiation and it's a discussion. You know, at the end of the day, everyone wants to win. So if the investor coming in is too aggressive and the company's in a pretty good position, you could say, look, this isn't the right lead investor for you. I don't like, you know, the terms that they're dictating to your early investors, you need to take care of them, right? You need to be able, you need to look out for them, not just the new investor coming in. And so maybe we go out and we find another lead investor. So it's a conversation, it's a relationship.
To Jeff's point, we haven't seen so much where they're able to affect that cap, that
Yeah.
valuation cap. But we have seen them force us to convert to a series, you know, if they're doing a Series A1.
Yep. That's the
doesn't
shadow,
have
yeah.
The liquidation preferences that the big gun gets
Right.
coming in with a $2 million check or whatever.
Yep.
We're seeing that more and more, which really puts us behind in the liquidation.
Yeah,
waterfall.
it's meant to treat the early investors the same as the lead investors. So it doesn't give them like a premium over and above what they, you know, their sort of their investment amount, right? So if there's a liquidation and the price per share is $1, but really you converted in at 15 cents, then the early investors are getting a little bit more of a windfall. Now, what you could say is like, yeah, but we're the early investors, right? We took most of the risk, so give us some additional preference. On the other hand, we do see, the lead investors in the Series A or Series C requiring this shadow series of preferred stock.
It seems to me that with greater liquidity in the market, that financial capital becomes more of a commodity.
Yep.
And there are a lot more sources of funds out there than there perhaps were there 10, 15, 20 years ago.
Yes.
And it seems to me that strengthens the early investors and the founders.
Yeah.
Hand, because if I don't like your term sheet, Mr. and Mrs. VC, I'll go find someone else.
Yeah.
And it used to be there weren't as many options. It seems to me that there weren't as many options for lead investors as there are now. And I think that's what makes angel investors so differentiated, is they don't bring just their treasure, they bring their time and their talent as well. There's a premium to be paid for that.
Yeah.
And I think that distinguishes between between investors, lead investors out there. We're not looking for just a checkbook.
Yep.
$10 million. We're looking for someone who brings in something with their $10 million, and we can all grow this thing in the line of our interests. Has market liquidity changed that?
A little bit.
Okay.
So certainly we've seen there's a lot more capital out there that's wanting to be put to work. And so we've seen a little bit more competitive term sheets. But the VCs are a little bit like gas stations, they all kind of they all strangely have the same price for their gas, right? We don't see a huge change in valuations just as a result of there's more capital that is being competitive with each other for some of these deals.
Okay.
We're seeing a little bit of it, but an investor or a company recently solicited some term sheets, and the valuations weren't that far off, so wasn't really necessarily making a decision. Fit for the company. So back to your point about bringing more than just cash to a deal, and really what that means is people use this term smart investor, right? And it's not that the investor like knows the business better than the founders do, but they're smart as in like a smart TV, right? My television doesn't know what I want to watch, but it has access to all the channels, right? If I want to see a David Fincher film, it's going to show me all the David Fincher films and where I can find them and how much they're going to cost. And that's really what a smart investor is. If I'm the founder, going to that investor and saying, I need a VP of sales. Okay, talk to these 5 people, right? I don't know if anyone are going to be your VP of sales. I don't know if they're going to be a right fit for you, but these are the right channels you need to start going to, right? So being a resource for people, capital, and opportunity.
Just one more question.
Yeah.
On this topic. It's a little bit of a fresh wound because we just got a term sheet from a company that you're aware of. I won't mention the name, but that we invested in last year as a note holder. And we learned that there's a seed round kind of late in the game. And and I understand everybody knows with a note round, you don't have pro rata rights. But we have been allowed to step into this opportunity. That the terms that an out-of-state VC, now we're seeing differences between out-of-state and in-state VCs and how friendly they are with the angel groups with making it a fair deal. But they came in with a term sheet that's setting the major investor at a high number, 500,000, a high number for some angel groups, especially us. So that we don't have, going into this round, we will not have pro rata rights, ability to participate in any, for the rounds. We won't have information rights unless we can negotiate those separately. And that seems to have not changed over the 10 years we've been in existence, as we're continually fighting with the VCs to kind of share in the, as early high risk investors. Being forced to do a convertible note, which I'm personally not a fan of, but we've seen more of those versus a seed round.
Yep.
then not, really being at the table as, as they go along. I don't know if there's a way, I mean, we have done
Yep.
side letters for
Yep.
information rights, but if there's anything more to do that we could secure that doesn't get overlooked.
So if a company is doing very well and it's continuing to proceed on its fundraising life cycle, its rounds gets larger and larger and bigger VCs come into play. So one of the consequences of a lot of capital being able to be deployed these days is that there's a lot of funds out there that want to invest at later seed or later stages, but they can't participate unless they're writing like a $5 million check, right? So it's going to gobble up a lot of the round. And so it's harder for the investors to make room for early investors as part of those much larger financing rounds, because so much of the pie is getting taken by these much larger checks. And so that's why they make the threshold as high as it is these days. And it's a trend that like we've been seeing at the company stage. You can do side letters, but then, the lead investor is going to have to approve those. Maybe where it makes more sense is as an investor to make sure that you're continuing to be aligned with the founder, and that if there's an opportunity to participate in future rounds, that if there's room available in a round, that you're going to get first priority in that position. But yeah, it's just sort of the reality of the economics of the way that these rounds are shaping up, certainly in later stages. I have a company that's raising $10 million on a $45 million valuation, and the lead investor wants to take 7.5 of that. Well, we can squeeze in our pro rata folks, and then there's a few crumbs left over. So safe's already mentioned, no maturity date. I don't know that I need to go into too much more detail on these slides since we're kind of bumping up against it. So,
Real quick, Matt, if
yeah.
you've got the trends of how many, safe notes you're seeing specifically in Michigan compared to, the past, and, is that we're the future?
Yeah, we're at this really weird stage in that I would say it's like 50-50 between safes and notes these days. And then, we'll have a nominal lead investor, but someone who's going to put in sort of the first dollars in a financing round, and they'll sort of dictate to the terms and say, well, I want to do a convertible note. And then we'll do a convertible note, and then we'll go out to other investors and they'll say, well, I don't do convertible notes, I only do safes. Right. And then we'll do it the other way. Lead investor says, I want to do a safe. And then we take a safe to an angel group that says, we don't like safes, we don't do safes, can we do a convertible note? So we're in this position now where it's like we can't sort of please everybody on the type of instrument that we're using. So you just try to navigate those waters. The VCs kind of hate convertible notes, so they always they're always giving you a hard time if you say like we raised our pre-seed stage in convertible notes. Well, why did you do that? It's like, because we're in Michigan and this is what investors like to invest on. So that's why we did it. And, we're in this really weird phase. I don't know how it's going to shake out. I do think that safes are probably the trend. But I think there's some things that you can do to kind of protect yourself with a safe and a side letter to make sure that you are, even though you don't have a maturity date on it and you don't have that kind of leverage over the company, that maybe you're getting some board representation or observer rights, at least, certainly information rights, and make sure that the company is more aligned with what you require in order to invest in the company.
What do investors see in a safe? Which feels to me like the loan I get from my dad.
Right.
Over a convertible note, even with the flaws in a convertible note.
Right. So I think the attractiveness of the safe is that it's incredibly easy, right? So basically the Y Combinator form of post-money safe is kind of like the gold standard these days. It's used in most cases. Since I'm not a fan of post-money, I tend to use a pre-money safe, but the only thing you're negotiating is the valuation cap. That's it. And then your financing round is done. So very simple. And there's a standard form of side letter, for major investors on a safe. So the rounds can be very cheap, can close very quickly. And there's just general consensus among certainly venture capital investors as to what is market, and there's very little deviation from it. So I think that's the real attractiveness of it. I think the other thing, certainly for the VCs, again, if a company, there's the experts and they're only right, 10% of the time, 15% of the time. So most of their deals are not going to work out. So they would rather have safes that just kind of float off into history rather than, notes that have defaulted that they somehow have to deal with.
And for an investment, would there be less, management on the back end of like a safe?
Yep.
There's less demand.
Right, right. If the company liquidates, they're supposed to give you your money back. Typically, if a company's liquidating, they probably don't have any assets. And so, I think accountants are still kind of scratching their head as how to treat safes. We haven't gotten any real guidance from the IRS on how that's done. So it's a little bit of the Wild West on how that stuff is being treated. I've seen, investors take the position that safes are 1202 stock, right? Get very favorable tax treatment from the date that it's issued. I don't know that that comports for 1202, but since the IRS hasn't said otherwise, you're seeing people take these kinds of positions.
What would otherwise be a 1202?
1202, yeah, is very advantageous tax treatment on the purchase of what is supposed to be equity securities, right? So a safe is not really equity securities, but it's also not debt. So what is it? Not sure. Pretty much.
Yeah, because one of the questions that's come up with safe is where does it, if you look at financial information, is it anywhere on the company's balance sheet? And I would say probably not.
Yep.
And so they could not disclose to you properly and have a number of items already signed that they're not, maybe according to what you're saying from IRS or generally accepted accounts, don't have to disclose.
Well, you certainly have to disclose, right? So
Yeah,
from a security standpoint.
But in standard format,
Yeah.
they don't have to disclose it.
Right, on the,
Buried in the footnotes.
yeah, to be buried in the footnotes, sure.
Well, any more questions? Feel good? Learned a lot. Thank you all for attending. And I will be sending out a brief survey for you all to complete. So thank you. And enjoy this beautiful Michigan day.